Hello and welcome to the Capital Call. I'm Quinn Millegan.
And I'm Drew Millegan.
And today we've got special guest David Deming, longtime friend and Director of Investor Relations for Pegasus Equestrian.
Hey, great to see you guys. How's it going?
Going well. Thanks for taking the time. And, before I get into it, we've got a very interesting segment towards the end of our This Day in Economic History. A lot of interesting stories that are going to be news to Drew and David. Of course, they might already know about it. And I did want to mention, and today is Juneteenth. Happy Juneteenth, by the way.
It was interesting. I woke up this morning and didn't realize the market was closed. So I woke up at the normal time. They were running HGTV reruns on CNBC.
It's true. But this will be released on Monday. Coming up this Friday, the 27th, we're actually, the Woodworth Contrarian Fund, myself, and Drew will be hosting a webinar on contrarian and value investing at 12 p.m. Eastern, 9 a.m. Pacific. I'll put the Zoom registration in the bio. Hope to see you all there. But there's a lot to cover this week. First and foremost, now I think the listeners would love to hear a little bit about you, David.
Hey, well, yeah, thanks for having me on, guys. My name is David. I'm the Director of Investor Relations for Pegasus Equestrian, working with both of you guys on this project. It's a private equity deal, large real estate developments that we're looking to get moving on here in Southern Oregon. We should create a lot of jobs, generate a lot of returns, and also, of course, be supportive for the equestrian community. So it's a project that I feel really good about working with and excited to see how it goes.
Sounds like an interesting deal.
Yeah, exactly.
To say so myself.
Don't you guys have to mention some disclosure about how you own this project?
Yeah. I mean, it's something we've been working on since basically our entire adult lives.
And it is.
We're not exactly unbiased.
Yeah. It is separate from the fund. It's not something that the fund would generally be a part of, but, it's certainly a big deal.
As a disclosure, this is not an investment solicitation, so don't treat it as such, nor is this financial advice.
Yeah, or tax advice, or legal advice, or any kind of general advice, or even relationship advice.
Yeah, especially not dating advice.
Especially not dating, not from me. Ugh.
Yeah, I appreciate you guys having me on. I mean, I'm certainly not like a financial expert or anything in this space, but just as someone who has been interested in markets for a long time. I studied economics in college, and I've always been fascinated by, the interactions between the financial world, the political world, and how that impacts people on a day-to-day basis. How these large, events, something as kind of abstract as the Fed changing what their rate is can impact somebody trying to buy a house, and how that affects families. And to me, the whole thing is just a fascinating system that I've been really interested in for a lot of years. So appreciate you guys having me on to kind of muse on what's going on right now.
And you studied in Texas, right? Austin?
Not Austin, San Antonio, though. This university there, Trinity University.
Well, all Texas cities are basically the same, right? Is that fighting words?
I don't think that's true at all. Yeah, the people of Austin might have something to say about that, and Houston and Dallas for that matter. They each have their own distinctive culture for sure. San Antonio and Austin do have a really cool relationship, though. The cities are about an hour and a half away from one another, so they are kind of like sibling cities in a way.
So it'd be like confusing Eugene and Portland in a way. Or Seattle and Portland.
I don't know who's insulted by that, but someone,
probably
maybe everyone is insulted by that.
Yeah, but I'm an equal opportunity hater,
But I think Seattle and Portland actually might be a decent analogy. Austin has definitely become much more corporate, much more expensive than it used to be. I think the growth has probably been a lot faster than something like Seattle or Portland has experienced. But certainly they do have kind of like a corporate, more expensive city versus a sort of more family-oriented, more affordable cost of living kind of relationship, like you might say Portland and Seattle have.
Yeah. It's a shame because Portland and Seattle used to be more one-for-one comparable, but Seattle's been pulling away from us in growth. So it's very much a corporate versus more relaxed vibe when you're comparing those two cities.
You look at the size of Seattle versus the kinds of companies it attracts and the GDP it generates. I mean, it just punches so far above its weight class. You've got both Microsoft and Amazon, two of the biggest companies in America, in relatively little old Seattle when you think about like New York or San Francisco or some of these other big cities that usually crowd out all the talented companies.
They're building out a world-class mass transit system too, which is just propelling that dense city growth, which I think is great for them. I wish Portland was doing something like that.
Almost seems like an accident that so many have have created a hub in Seattle simply because of association with maybe Microsoft and Boeing.
It could be. Amazon's was very intentional, though. Jeff Bezos will talk
Yeah.
about how he chose Seattle specifically because it's the linchpin city between trade with the US and China, being our
Yep.
largest port, our largest deep water port that is closest to China.
That makes sense. Yeah.
Makes total sense. Plus the agglomeration effects of just being in an area which has a lot of that growth going on.
Mm-hmm.
I find it interesting, for those that might remember, it used to be a saying of last one to leave Seattle, get the lights. When Boeing had its issues in I believe it was the 80s, Seattle really did used to be basically a company town for Boeing. So the fact that it's grown and diversified as it has is a real big win for the city, I would say. They're not a one-trick pony anymore. So, speaking of the Fed, you mentioned the Fed rate. That was something that we did have happen this week. The Federal Reserve kept its interest rate steady at 4.375% midpoint, which surprised some people. Didn't really surprise me. But
You
the
can't
Fed
be
has been
fooled. Can't be surprised.
can't be surprised. I can certainly be surprised by the Fed, but their job is to keep inflation under control, and with the dual mandate, they also have the goal of keeping unemployment low, which sometimes those two goals can be at odds with each other. But if you've been following the economic data and watching inflation reporting, inflation is way down. It's just above 2%, I believe, year over year inflation right now, which is fantastic. And unemployment has not really been it's ticked up a little bit, but you're still talking like sub 5% unemployment overall.
Yeah, it's remained steady at 4.2% over the last couple ticks.
Yeah, so it's, there's not really a lot of cause to raise, not really a lot of cause to lower. Some people are complaining because financing costs generally are up right now, especially if you're in real estate. It's not great. They kind of exist in the margins of cheap financing, just because margins are so slim when you're talking about development and real estate generally.
I think what people sometimes forget about the Fed when they, raise and lower interest rates is, yes, the stock market and real estate investors would love interest rates to be, near zero as possible, but that's not the Fed's job. It's explicitly not the Fed's job to cater to those kind of whims. It's to keep other inflation and unemployment in check. That's the only goal.
In fact, that's the secret sauce of the Fed, right? I mean, before we invented central banks, that was always the problem. We'd print money and then we needed a little more money, so we printed a little bit more. And I think the independence of the Fed is one of the great successes of the American economy.
Yeah, ever since we figured out how to print money, we've been printing a lot of it. I do find it interesting. You can kind of divide up popular opinions about monetary policy in the modern age, kind of between like the 1800s, when we didn't even really have a concept of fiat currency floating separate from some sort of commodity. Then you have the 1900s, where people figure out that, we can separate our currency from a commodity and we can get a lot more bang out of our buck and get some inflation, but it keeps things moving through the economy. And now you're kind of in this new age of like everybody dropped their rates to near zero, and there's not really a whole lot further to drop unless you go negative, which isn't really sustainable. So we're in this kind of new age where we're so close, we started out so close to the bottom. Like, what do you want them to cut their rates to zero again? Like, there's only so far to go, even though we are at like above 4% right now. It doesn't give you a lot of cushion.
Yeah, after I don't know, somewhere around a decade of rates being near zero, and then with rates coming up, of course, to combat inflation more recently, it does feel like the market has kind of forgotten that these rates are still low, historically speaking.
Yep.
Even though everyone's complaining that rates are super high right now, and they certainly are high relative to where we've been for the last decade or so. In a historical sense, these are still generous rates, and I'm with you. I feel like maybe Powell at some point or the Fed might drop a quarter point or a couple quarter points just to signal to the market that rates are getting lower and try to like win over some media cycles or something. But it's hard to see why they would drop it much further than that unless we were able to both get inflation under control and the economy started shrinking. Only then their dual mandate would kind of allow them to do it. Kind of like what you said a minute ago, Drew. I don't think anyone was really surprised by Powell keeping rates steady. The markets barely reacted, but it certainly has surprised people, at least given predictions that they made a year ago. People were more hopeful, more optimistic that the Fed was going to cut a few times this year. And they're now starting to wake up to the reality that things might be a little less certain than they were hoping they would be.
Wake up and smell the tariffs. You know,
Mm-hmm.
I think it's interesting you point out from a relative perspective, this is actually a tighter fiscal policy than people were expecting, even if it's basically just a rate unchanged kind of environment. There's loosening policy, and then there's loose policy, and then there's having tight policy relative to where you were expecting it to be.
Yeah.
So there's an argument to be made here that with recent uncertainty, like if we hadn't had all this uncertainty with the tariffs and international trade, we would actually be lowering rates more right now than we would be otherwise. So you kind of had these, it kind of goes back to this thing I've said before, where it turns out that I guess if you want to raise tariffs, you should do it when the economy was otherwise going to grow. Because those two forces kind of counterbalance each other. The inflationary effects versus the deflationary effects kind of come into balance.
You know, this brings up a question, and I don't know the answer to it. Maybe you guys know. Does anything prevent the Fed from just raising rates by like a 20th of a point? I mean, can they do that?
You know, that's an interesting point, because
It's always a
all
quarter
relative,
point or
right?
whatever.
Like, there's a big difference between lowering from like a midpoint of 1% to a midpoint of 0.75%, because that's only a like 0.25% difference, but that's very different than lowering from like 20% to 19.75%. That's a very, very small difference.
Yeah.
So there's a good argument to be made that as interest rates get closer to zero, the Fed should be cutting and raising by a proportionate amount.
I mean, as far as I know, they could absolutely do that. I think they just don't.
Right. I would agree with that. I mean, they're kind of creatures of habit, you know. The Federal Reserve is all about certainty, right? So you're trying to keep things stable, you're trying to keep things consistent, you're predictable. So if they were to start doing that, it's kind of like using untested policy, which, you know, the Federal Reserve as a central bank is very, very conservative. They don't want to do anything unexpected, which actually kind of brings up another point. I don't know if you guys have thought about this much. I saw some speculation in some of the markets and some of the outlets. What happens, because Powell's term is coming up, right? What happens if one of the other Fed governors comes out as a so-called shadow governor? If Trump announces ahead of time which of the governors is his favorite pick, and then suddenly this shadow governor starts making public statements that he's going to cut rates once he gets into power, that alone, because messaging is really, really important with a central bank, would probably be enough to move markets and kind of undermine whatever the outgoing chair's policy would be. So there's very real speculation here that if a shadow governor were to present himself, it would be a really big deal.
But don't the all the members vote collectively, so it couldn't really influence any policy, even if he was the head of the Fed necessarily.
They do, but the Fed governor is the one that leads policy and is also the one leading the messaging on policy. So Fed governors can make statements, and you know, a lot of this is just convention. Like, there's no reason any Fed governor couldn't come out and start saying wild things on his own. They just don't, because that kind of runs contrary to what their whole job is, which is to keep things stable. You know, it's very uncommon that you get a Fed governor that's very activist. They're very bureaucratic, very technocratic type roles, which is a good thing, because otherwise you wind up like Turkey, which I don't know if have you guys looked at the interest rates in Turkey recently?
No.
I have. So I've actually got a magazine here, The Economist, which is great because it gets there's all this regular data that I would otherwise just not even get served by the algorithm. But in the back, they have this spreadsheet called Economic and Financial Indicators, which is just basically a print of the raw data of CPI, inflation, and central bank rates and all that. And I was looking through to see which ones had the highest rates. Just give me a guess. What do you guys think the Turkish central bank rate is right now?
27%.
Higher.
What?
Higher.
80%.
No, that's too high. Okay. Now you're just getting silly. The current key rate for the Turkish central bank is 30.6%.
Wow, that's pretty high.
How to put that in context, their current consumer prices from a year ago are up 35.4%. So it's actually not unreasonable given the environment they're in. What that tells me is they probably should be raising rates even higher.
Are they issuing bonds at that rate?
Yes. Yeah, that's their bond rates right now. So they're paying through the nose.
Holy cow.
Does that mean the Turkish economy is growing currently?
Well, let's check, because I've got that figure in the back too. So over the same time period...
Probably an issue of inflation, right? I mean, if their money's just devaluing at a really fast rate, they probably have to pay out.
Yeah, there's a difference between nominal GDP growth and real GDP growth. And if you're not an economics wonk, you're not going to necessarily know the difference between those two. But real GDP is just nominal GDP minus inflation, because inflation inflates the value, right? So current gross domestic product change from a year ago is 4%.
So they're not doing so hot.
Yeah, not doing too great. It could be worse, could be a lot better, I gotta say. I'm actually not even sure if this is real GDP or nominal GDP. If it's nominal GDP, that's really, really bad. If that's real GDP, that's actually pretty good. But the problem that the central bank has in Turkey is that it's not independent of the executive. Erdogan is kind of changing interest rates by decree.
Erdogan has kind of an iron fist as far as I'm aware.
Yeah, it's not great. There's a reason why you have an independent Fed. Some people really fight this, but if you don't have an independent Fed, you get Turkey. And
I mean, to get back to your point about Trump appointing potentially a shadow governor on the Federal Reserve, I mean, I feel like this is the classic fight that all presidents have with the Federal Reserve. Every president wants lower rates because that juices the economy in the short term, but depending on the financial situation, can cause destruction in the longer run. But by that point, they won't be president anymore.
right.
It's not a new fight. I do appreciate how the Fed has remained so independent from the executive branch for so long. Certainly, Trump has been attempting a farther reach as an executive than previous executives had. So I don't know. We'll see. He's certainly testing a lot of other federal institutions, and we'll see how the Fed holds up. One thing that I am grateful of, though, is kind of to your point, though, Drew. He can't just appoint anyone who he chooses to. He does have to choose from one of the Federal Reserve governors that already exists. So he is limited. He can't just select, someone who is directly connected to him and can set the rate whatever they want. There is still some independence. So I appreciate that about the system.
He can't just appoint a wellness coach, They have to be from that pool.
And I think they all have 13-year terms, 14-year terms, so it's kind of irregular.
Yeah, and that's definitely, but that's by design. It's to kind of make it very, very hard to politically interfere. To makes them kind of like judges in that sense, where they're not exactly appointed for life, but they're just systemically more inclined to be from like a more technocratic background, just because of how like central bank governors themselves are also appointed. You can kind of play some games with that if you've got a more long-term time horizon. Like I know it's been a long-term Republican strategy to appoint a lot more conservative judges at the local level because that creates a pipeline for more conservative judges at the higher federal levels. But that takes a lot of foresight to get that going. So you're not going to get any of that for short-term rate increases. The interplay is interesting.
Well, I think top of mind as far as current events that do impact the economy, the conflict with Iran has been hugely impactful. I mean, I think on our last Capital call, it was one day of there was the strikes and the market kind of had a panic, and now Israel controls the airspace over Iran, and there's potentially U.S. involvement. So how does that impact the U.S. economy? Again, and I've said this before, conflict in the Middle East just does not have the same impact on the bottom line for American companies that it might have had 25 years ago. And that's just because we're a net exporter. That's a huge contributor, but definitely something to pay attention to.
Yep. I would say the energy mix overall is a lot more diversified too. So not only are you not getting all your oil from one place or one region, you're also not using the same kind of fossil fuel for your energy needs. So there's usually a mix of there's more of a mix of renewables, natural gas, and oil as opposed to just oil-based energy sources, which I think is contributing a lot to this. If you look at the projections for what people are thinking is going to happen with oil prices, I don't know if you guys have been following that too closely, but JP Morgan and Citibank recently came out with some projections as to where they would expect the oil price to be going. If you're talking about a disruption from Iranian oil, like, a limited war of sorts that just kind of continues and takes out some oil capacity, Citibank currently is projecting between about $75 to $78 per barrel oil for Brent crude, which is usually what Europeans use as their benchmark. We use WTI crude, Texas Intermediate, which is usually a little bit cheaper. But if it was all, and to give you some context, back in January, oil peaked at like $81.73. So this is not really that unusual of a price. Oil was ticking down because OPEC production targets were increasing. But if we were actually to go like full on war and all of Iranian production was totally cut out of the mix, you're talking like $90 a barrel oil. Still not totally unheard of, and you're basically going back to like January, a bit higher than January. It's marginally. Like 12% higher. Not great. And if you were now I've said this before, but the real danger is what happens if the Straits of Hormuz get closed. And that cuts off not only oil, but also liquefied natural gas shipments from places like Qatar, as well as exports from Saudi Arabia, which Saudi Arabia has been trying to get a pipeline and rail connections to their west coast for a long time now, but it's still not really fully developed out, which means they go out the Persian Gulf. So if the Persian Gulf gets closed, you get a lot more than just Iran taken off the board. At that level, you're talking $120 to $130 per barrel oil, according to J.P. Morgan's analysts. But again, that's Brent. So the primary impacts you're talking for that expensive oil is going to be Europe. It's going to be India. And it's going to be China. Again, because the U.S. is a net exporter, we'll have that blow a bit softened.
It's interesting you bring up Saudi Arabia's production on their pipeline to the West Coast. You'd think that they would prioritize something like that over the Noom and the Wall and whatnot. The like Wall City or whatever.
Yeah, the line.
Yeah, I'm kind of surprised by that too.
Neom. Yes, yeah. Neom.
That's an interesting concept of a city. It's not the first time it's been tried either. Saudi and kind of the Middle East generally has this propensity towards trying to build out new expansive cities as part of their anxiety over like what happens when the oil runs out or, we stop using it. Like we want to be able to convert this mineral wealth into something that sticks around after this kind of a fossil fuel transition. So a lot of these cities are allegedly based in like, let's get a tech base going, a place where you can do a lot of high tech jobs, or like the UAE has like a space program, which people don't always realize. It's relatively small, but it's not nothing. I can't believe they're actually building it though. It's got to be one of the worst examples of city planning I can imagine. Everybody in the line like that, you lose all the agglomeration benefits. I mean, arguably you can have a train running the length, but it begs the question, why didn't you just build it all compact where you could have all the services in one place? You're just making you're getting all of the costs of sprawling your city out and dispersing your services with all the single points of failure of something that's built in a line and kind of losing the agglomeration benefits of having a lot of those people living within like radially a reasonable distance of each other. Instead, you've got people connected by their neighbors only in 2 dimensions. So why are you doing this?
I mean, if you have the space, why not? It looks kind of cool and everybody has a view.
I mean, yeah, I guess maybe you'll have everybody work from home. And, the argument is that maybe they're trying to build it like you can imagine it as several different vertical cities connected in a row. Like that I could imagine.
And there's a train that goes through the middle.
Yeah. The way I've seen it speculated, you would have like a local land and express. So you would have kind of like, which is how, cities design their transit generally. You have radially radiating out from certain transit centers, but it's a statement. We'll see if they do.
Yeah. Oh yeah, go for it, Quinn.
Oh no, go ahead.
Well, I was just going to say, to get back to your broader point though, on the emerging, what looks like to be a war here between Israel and Iran. And of course, the really unfortunate tragedy of the loss of civilian life, the destruction of infrastructure for both countries. And I hope that there's as little harm to people as possible in this, of course. But it does surprise me, given the enormous uncertainty that an event like that creates, along with the uncertainty that's kind of being generated right now with this tariff policy, that the stock market remains at all-time highs. I feel like the thing that we hear from business leaders over and over again, and what seems to be true across a lot of economic history, is that uncertainty generally creates lower values over time, because you're not able to predict as far out, you're not able to invest as far into the future. And certainly we can talk about the effects of a minor war and what that might have on oil prices and how this might affect the ability for certain countries to ship resources. But if we see a major war developing here between these two powers in the Middle East, that could have all kinds of knock-on consequences that we can't know about. And then on top of that, the US's involvement in it, potentially dropping, I mean, I think Donald Trump is weighing dropping one of our large bunker-busting missiles on a deep underground uranium enrichment site. just the uncertainty on all levels of this has me kind of shocked that we're still seeing such high stock prices. And I'm just curious to get y'all's opinion on this. What do you think it is that the market's musing on right now that makes it think that there could be higher returns? I mean, especially for growth companies, they're just predicting so much growth going forward.
I'm not really that shocked, but to give you an idea as to why Iran important to the important to the oil markets. It's the third largest producer in OPEC, so it's important. But the problem is that Iran is not really that developed in terms of its total economy. To give you an idea, like Iran is so much bigger than Israel. I mean, Tehran alone has like, I want to say 13, 14 million people. It's a megacity. But if you look on their per person productivity and their GDP, it's really, really low. They've been heavily under sanctions for decades at this point, decades upon decades, which means that in the context of the global economy, if you're not talking about basic mineral extraction, Iran is not that relevant. And a lot of those risks of the Middle East are kind of already priced into the markets. I can think of some circumstances where specific companies are occasionally affected by uncertainty in Israel specifically, because Israel has a very well-developed and high-tech manufacturing base and expertise in that, and it is well interconnected with Western capital markets. However, if you're talking like Iran and those other countries, it really just doesn't even really register in Western capital markets anymore.
I mean, and the US has been aggressively cutting Iran out of Western capital markets.
Yeah.
You know, in a sense, we are like the Western economy is certainly insulated from their effects. But I mean, just today, Israel's stock exchange was hit with a missile. Their largest hospital in Tel Aviv was hit with a missile.
Mm-hmm.
Is the assumption by the stock market just that Israeli defense is so strong that it's like losses will be minimal in this war, I guess?
Well, here's how I see it. Because the Middle East just generally is less important for the U.S. economy as a whole. The short-term effect of either losing output or losing certain productivity from Israel in the short term doesn't really affect the U.S. economy. Now, there's the uncertainty of a long-term, larger conflict. The U.S. stock market booms during war. So, I mean, it's a terrible thing to think about, but the correlation is high. During times of war, American companies make a lot of money. And so even the long-term uncertainty is still good for the stock market, and the short-term uncertainty is not that impactful. And I think that's a little bit what you've got going on. The other thing is, with all this tariff uncertainty that we've seen since February, the stock market has been beaten into submission. And so this level of uncertainty they don't really care about anymore, because they've already made their assessments, and people that were high flying just because it's high flying kind of left, and you've got investors that are okay with the uncertainty.
Mm-hmm.
I would totally agree with that. Another way to put this is this, like why did the U.S. boom post-World War II so much more than, other large countries? It's in part because our infrastructure was basically unaffected by the war. The U.S. was the world's factory for decades and decades, and we really benefited from that. And we were the world's factory during the war because our stuff didn't get bombed. We were too far away. So when a war happens, it's almost never, you'd have to look back very far to see like actually impactful fighting happening in the U.S., like basically the Civil War, or like the westward expansion that you had, or the Spanish-American War in the early 1900s.
I know typically a lot of this expansion in the market is because, I would guess it's because of two factors. One, because there's additional government spending, and then two, because there's kind of a flight to safety. So maybe capital from other markets is coming to the US market. At the same time, though, if there is additional government spending on the US part, does that increase concerns around U.S. credit worthiness? I know that's been a big topic in the news for kind of the last few weeks. And the consensus seems to be that everyone generally thinks that the U.S. is probably good for all of our debts, but there's definitely more concern about that.
The problem, I know exactly what you mean on that. The problem is that, let me put it this way. Foreign holdings of U.S. debt is actually near all-time highs right now as a percentage. It's at I want to say 40% or something like that. And it's just been rising. As the rest of the world has gotten richer, a lot of that capital has come into the U.S. markets. And there was speculation as to, especially as bond rates became decoupled from the Federal Reserve raising or lowering rates, there was that period where it's like, oh no, bond rates are going up because all the foreign holders are selling off all in unison, basically. And there was a lot of speculation that was like China doing that because of the trade war. But what we've kind of settled a little bit on in terms of like just the rate, like it's gotten more stable. It's stabilized to a certain extent, which you've seen a lot of the selling go away. I mean, the whole world is kind of weak right now, is what you've seen as a result of this. So everybody's feeling the pain. And unfortunately, that means that if everybody's equally feeling the pain, the U.S. is still one of the best places to put your money if you can get it there.
And I think we've got, what, 5% of the U.S. of the world population and like 60-70% of the world capital markets.
I mean, calling it the U.S. equity market is a little bit misleading. These companies might be based in the U.S., but you look at a company like Meta that has almost 3 billion users, 3 billion daily active
Yeah.
users.
It's insane.
And these are really global companies.
Oh, yeah.
Yeah, exactly. You can think about it this way, like if you guys are very aware of like the British pound sterling, that used to be the currency of global trade was the pound. That's why they basically were able to stay out of the EU, the Euro zone, was because the pound sterling is still kind of this widely perceived to be broadly reliable currency to issue like a lot of debt and a debt denominated in that. The US is kind of in a similar position right now. So the US could blow this lead. It's possible. But if you look to the UK's sterling for a historical example, it takes a very, very long time to lose that lead once you have it. It takes a long time for those countries to like de-dollarize, and they have to find an alternative to move into that's might not even be their local currency. They might move to the euro, or like there was a push for a while to try and move into the Chinese renminbi or the Japanese yen. And the problem is those markets are just not as deep as the US dollar. So you've got this network effect, kind of like Facebook, right?
I
Yep.
mean, and as they grow and pay more taxes, they're going to need more currency. And, of course, all the other knock-on effects of paying employees and subcontractors and all that.
But Drew, what about bricks? And if you could explain for the listener what bricks
Exactly.
you're referring to, not red bricks.
What about bricks? I hate it when people bring up bricks. It's the most annoying comeback in the world because bricks doesn't really, it's not a thing. These countries don't coordinate. BRICS is an acronym, BRICS. It stands for Brazil, Russia, India, China, and South Africa, which is weird. These are countries that don't necessarily have a lot of trade with each other besides Russia. Russia, China, and don't really coordinate. They do have meetings. There was talk of having some sort of competitor currency to the dollar, maybe trying to de-dollarize, and it's just not manifested in any meaningful way. I mean, I would argue OPEC is more powerful than these guys. South Africa in particular has kind of fallen off as a relevant global player in that sense. There's still a lot of stuff denominated in like South African currency.
Is the idea there that they're trying to create maybe some kind of a cartel-like system similar to OPEC, but around like resource materials?
You could argue that, but whatever BRICS is trying to do, I've just mostly ignored them. As far as I can tell, they just like, especially like if you talk like India, China, those are the two biggest countries in the world, and they hate each other.
In other news, just to flow through some of these topics, we're gonna have to get your number one stock pick, David.
Is that a requirement of all the guests that come on this podcast?
Yes. Yeah. No. You don't have to.
I won't give you any kind of a stock pick on this one though, but I will say I did do some research on the Mag 7 in addition to my typical just kind of interest in the topic. And I will say it does surprise me how out of favor Google has fallen from the Mag 7 more recently. I mean, even if you just do kind of the basic sum of its parts with all the various separate entities that fall under the Alphabet umbrella. I mean, YouTube as the most popular streaming site, which is gaining popularity among seniors who watch it on TV. That is the fastest growing segment of YouTube users right now are seniors.
Wow.
which I think really just speaks to how every other age segment of YouTube is already so saturated. But between that, the immense amount of AI talent that they have there, I mean, I know OpenAI is kind of
Wow.
running away with the AI game right now, but still, with the amount of talent that's concentrated at Google, you can never quite count them out. And with the fact that Waymo might be on the precipice of eating Tesla's lunch as we speak this month. I mean, Musk has said that he's bet the company on the success of the RoboTaxi, which he's been promising for 10 years, has said repeatedly he's going to deliver this month, but is now under legal constraints potentially from releasing in Austin, whereas Waymo's already delivering millions of rides a year at this point.
Yeah.
So I just think if you do a basic sum of its parts analysis on Google and the parent company Alphabet, it's hard to see why it should be trading at a PE of something around like 18 when the S&P 500 average company is trading around a PE of like 26 or 27 right now. All that to say, the market has really counted out Google's value right now, I think just because of the success of OpenAI. But on a revenue basis, on a diversification basis, I just think it's hard to count this company out. And it's been surprising to me how much the market has devalued them relative to the other six members in the Mag 7.
Yeah. I think investors in the Mag 7 really like the idea of very powerful future momentum, and to see it kind of waning is, I think, why it's been hit, but maybe unnecessarily so, right?
Yeah.
I think you could easily see a situation. I do think that they are finally coming into a competitor. And I think Google investors once thought that, okay, no one's really going to ever compete with Google search. How could you? I mean, Bing, get out of here with Bing. But people are increasingly using LLMs for their search needs. I mean, I think Apple's talking about potentially replacing Google as their main search engine with Perplexity. And Google is basically playing the catch-up game, which is very rare for Google to do. But that being said, I think you could easily still see their main search component step ahead, even if they're not the first mover, and regain some of that market share. And you're right, some of the parts. YouTube is massive. I did see an anecdote that I saw. They were comparing average ride prices in the Bay Area. They went with Lyft, Uber, and Waymo consistently. Waymos are more expensive than Ubers and Lyft, but people are still riding on it.
I think it's interesting you bring up with, Waymo's more expensive. I think the self-driving taxi thing is kind of an overplayed thing. Being someone who's just a general transit nerd, I don't think self-driving taxis really save you all that much money compared to just having somebody drive the taxi. It also doesn't solve traffic, so it feels like a solution in search of a problem. Thrown resources into that, kind of like famously with like Elon Musk. He's kind of thrown resources into it as kind of like this counter argument to investing more like rail infrastructure, like proven technologies like that. He's basically saying that it's going to render those transit modes out of date. So
Drew, but you sound like somebody who is trying to explain to me why the horse is a more reliable form of transit than the car, right? I mean, this only just came online about a year ago. We have investors who believe that Tesla is worth nearly $1 trillion based on the RoboTaxi model. And Waymo's already serving over 1 million rides a year. Of course, it's going to take a while to get the costs down. But the fact that you don't have a person in there and you just have capital, it's happening right now. It just happened now, this year.
It feels kind of like fusion power, it's just perpetually 15 years away.
Well, not yet.
And it's kind of, except it's perpetually like 5 years away. It is, but it's not. I'm still not convinced it's saving that much money. Like the argument is that you get like you wind up. Not yet. I just don't see it achieving. I feel like the inefficiencies inherent in a taxi system or even just like a car system isn't in the labor required to drive or be picked up. It's in the fact that they're just kind of space inefficient, especially in urban areas. You can make the case that like Waymo would be super useful in a more decentralized suburban kind of environment, which makes sense why San Jose would be San Jose and Cupertino. Those would be the kind of cities where people would believe in that kind of transit. But like in the areas where you've got a lot of that.
One thing to put in context is the amount that Waymo's cost more relative to Lyft and Ubers is only like $1 per ride. Like it's not that substantial, and it's just beginning. Now to your point, essentially, I mean, we've reinvented the bus as far as all this driverless doesn't really matter, and then the bus reinvented rail. And so you're right, it's nothing new. It's just in a different format. Doesn't mean it won't work.
I think there's so much more than this, though. I mean, we found a way to create a transit system that has the whole functionality of the car and somehow at the same time many of the benefits of a rail system. You're able to get into a car. Ideally, I mean, again, this is the first year they're launching it. Technology is going to get cheaper, production is going to get cheaper. They'll find ways to improve the safety and effectiveness of it. And the idea that you could essentially get that time back into your day by riding in one of these vehicles instead of having to drive around. I mean, this is huge. This could save lives if this becomes safer than human driving. This could reduce the need for parking lots, something that I know is near and dear to your heart, Drew, because all of a sudden people don't have to park their cars somewhere. They can just get in, get out, and that car is immediately. It's a huge drain on cities, causes a lot of. I mean, there's enormous environmental impacts from parking lots. I think there's enormous upside here. Maybe it's slightly more expensive right now, but guys, this is the first year it's ever been released. Of course, it's going to get cheaper from here. Would I love to see more trains? Sure, Drew, but I don't think that's the kind of economic system that we're going to see anytime soon, unfortunately, unless there's a mass political movement that's pro trains. And there's so many benefits to this that I see this as a huge win. It's going to be a huge win for Google in terms of its value, probably, but hopefully for people as well, getting the time back, making cities work more efficiently, perhaps not having to invest as much in cars, which is a huge expense for a lot of people. There's a lot of knock-on benefits that as they perfect the technology we could reach.
I guess, David, how with autonomous driving, what is the largest difference between that and just Uber and Lyft as far as the benefits? Because you get a lot of the same exact benefits from just basically taxis or Uber Lyft type ride sharing. I mean, you get rid of the people's need for cars themselves.
Sure, it's the cost ultimately. I mean, that's the ultimate goal that these companies are working towards, certainly. And Google has not achieved that yet. I think Waymo's takes somewhere around 150 to 200,000 to manufacture right now, which is not cheap for a car. But I think the idea is that over time they'll find ways to reduce those costs, gain a larger market share, more consistent revenue. And they'll be able to work that down.
I will say there is something to the point that part of the reason that people like cars over like taking transit is it's a private environment. You don't have to share with anybody else. And it's got such a huge degree of flexibility that you don't get with transit, at least not in the US. So you don't have to, you basically just build out the road system and they can run wherever they want end to end with great last mile delivery. You don't have to walk at all if you don't want to. And it's just nice. A lot of the efficiencies to do with transit have to do also are very, very closely linked to land use, which you can't change on a dime. The nice thing about cars is they're so flexible that if you suddenly don't want to go to downtown, like if you don't want to go to downtown LA anymore because your job is in an adjacent suburb, you can just do that. There's no, like, the roads are already there, and you just change the direction your car is going. One of the main problems you have with transit is that, at least not with at least with non-bus based transit, is that it's fixed. So the commutes of yesteryear influence the direction of commutes you have to have now. People are still going to downtown New York City to get somewhere in an adjacent suburb, or, again, with LA, you have to go through downtown LA to get anywhere.
Sure, absolutely. And just to be clear, I mean, ideally, we'd have walkable, interconnected, multimodal, green, transit-oriented cities. I mean, of course, that offers the highest quality of life and the best well-being. I'm talking about just what I think is most likely given economic trends, not necessarily what I hope to see in the world.
Yeah. I do think it's interesting, though, with Google. There is some potential growth there. But what I would say is that, like to your point before, a lot of the industries that Google is in right now are mature. So part of the reason they're getting this discounted valuation is that people aren't convinced that Google is going to own the future anymore. It may be that Waymo is the future, and, those self-driving car tech could go a long way, but an 18 times multiple is not nothing. Facebook has been trading at a very low valuation compared to the other ones historically. I remember there was a time when it was like 8 times earnings. It seems to be more of a factor of it just owning the market. These companies become gigantic conglomerates, and they become not only difficult to value but difficult to grow. And they start being assigned multiples that are assigned to just the economy broadly, because it's hard to own more than 100% of a pie.
And investors will make a lot of money if they break up Google. YouTube could be its own company.
Yeah,
Waymo could be its own company.
Rockefeller golfed the best game of his life the day that they broke up Standard Oil, and he made billions of dollars. So
I think that is the great irony with so many of these companies is that ultimately, like they fight so hard to not be broken up, but shareholders probably would benefit within a few years if they just broke them up.
They're just looking out 6 months.
Yep. They said the same thing about AT&T. They said, oh, no, this will never work. And then investors made a full of money.
Yeah, I think there's just an aversion to change that they don't control. Change is scary, but it's necessary for actual real growth to occur. That's true generally.
Speaking of change, I think it's time for this day in economic history.
This day.
I've got some interesting stories for you, guy. I do want to point out that I am drinking a caffeinated Baja Blast, not from Taco Bell, but by the local coffee shop.
Is that a plug for the local coffee shop? Who's the local coffee shop? Let's give them a plug.
Gold Rush Coffee Shop.
Gold Rush.
We'll give them a plug. Go to Gold Rush.
Gold
Although
Rush.
apparently Taco Bell now has an energy drink, which I have yet to try.
That just goes to show all the values out of Dutch Bros these days. In my opinion, that's my stock opinion.
Well, today is June 19th, and we'll look at it throughout history. So, and I've got two little things and then one longer story for you guys. So, June 19th, 1993. Amid Depression-era oversupply, Secretary of Agriculture Wallace unveiled a cotton subsidy. Farmers were paid to plow under millions of acres, deliberately destroying crops to bump up prices.
You just love that market manipulation.
Oh, yeah.
I remember the mob did something similar famously. I believe it was with onions, which meant that the mob is the reason you don't have onion futures because they made it illegal after there's some market manipulation they did in Chicago.
June 19th, 1978. In a lighter, but no less significant economic event, this marked the debut of Jim Davis's Garfield comic strip, which would grow into one of the most successful merchandising empires in publishing history. What began as a simple comic about lazy, lasagna-loving cat evolved into a global commercial juggernaut generating between $750 million to $1 billion annually in merchandise sales. He explicitly created Garfield with marketability in mind, focusing on universal themes that would translate across cultures and avoid potentially divisive political or social commentary. By 2004, Garfield appeared in nearly 2,600 newspapers worldwide and spawned an empire of books, TV shows, movies, and all that business. And I just plugged that because I love Garfield.
Yeah, it's true. He's got a Garfield calendar on his desk. It's a new comic every day.
But I have kind of a longer story, and this one I thought was quite interesting. And so there's some legend and there's some truth to this situation. So I'm going to roll you through the chain of events. Picture it. June 19th, 1815. Europe is still smoldering from the cannon fire at Waterloo. Napoleon has finally been kicked off his war horse for good. His dreams of continental domination now lie somewhere between a muddy Belgian field and a punchline at British dinner parties. Meanwhile, back in London, the financial world is nervously chewing its fingernails. No one knows who won. Rumors swirl. The stock market holds its breath. Government bonds twitch like a cat in a thunderstorm. Now cue stormy seas. A mysterious man, Nathan Rothschild, allegedly watched the battle unfold, hops on a galloping horse, bribes a fisherman, sails across the channel, arrives in London soaking wet, and rushes into the stock exchange building shouting, "Sell everything." Panic ensues. British bonds plummet. Rothschild buys them all back up at a fire sale price. Then the real news hits. Britain won.
What a guy.
The market rockets back up. Rothschild makes a fortune and becomes the financial equivalent of Sauron with a Bloomberg terminal.
Outrageous.
And it's the perfect story. Espionage, market manipulation, powerful banking dynasty, and a very villain for 19th century conspiracy theorists to obsess over, which makes it even juicier that almost none of what I just said is true. It's a legend that is held throughout history as kind of a farce of what actually happened. So what actually happened, the Battle of Waterloo took place on Sunday, June 18th, 1815. Napoleon's French Imperial Army was decisively defeated by the combined forces of Duke Wellington and Field Marshal Blucher's Prussians. By nightfall, it was over. Napoleon lost. But here's the thing. The information superhighway of 1815 moved at the pace of a tired horse and a guy with bad handwriting. London didn't hear about the victory for another 3 days.
Oh, wow.
And so what happened on June 19th? What we know is that on the morning of June 19th, Wellington sat down in a battered Belgian farmhouse and began writing his official dispatch. He finished it in Brussels, where his aide-de-camp Major Henry Percy picked it up. Percy then left with 2 captured French Eagles and a mission: bring the news to London. Meanwhile, the press in London was printing wild speculation. Was Napoleon dead? Was Wellington defeated? Had the Channel sunk? Now, the Rothschilds. Nathan Rothschild was in London. He wasn't on a horse. He wasn't in Belgium. He was not bribing fishermen. But he did have one thing the government lacked: an insanely efficient private courier system. And so Rothschild's network of shipping agents, pigeon posts, and relay riders could outpace the British Army. Since the early 1800s, Rothschild and his brothers had been shipping tons of gold across Europe, fund the war against Napoleon, and they bailed out Wellington's army so many times they practically deserved a personal battalion. And so there is credible evidence that Rothschild received a letter on June 19th or 20th with early word of Wellington's win. Likely from Ghent, not from the battlefield, not from fireworks. It was an envelope. Because the entire myth comes from an 1846 pamphlet written by a French propagandist named George Derneville under the name Satan.
What?
He claimed that Nathan witnessed the battle, crossed a stormy sea, tanked the market, and walked away with 20 million francs. But none of that holds up. There wasn't even a storm. Nathan wasn't in Belgium. The British government's own bond market, the consols, did not crash on June 19th. The British consols averaged 59.90 in 1850 and yielded about 5%. There were fluctuations in the days after Waterloo, but no sudden collapse, no massive panic. And Nathan probably did make some trades. He probably bought on June 21st and then sold on the 22nd. But historians estimate that he probably only made like 7,000 pounds on that. And here's what did happen. Major Percy arrived in London on the 21st. He rolled in St. James Square in a dirty post-chase with 2 French Eagles sticking out of the windows. He crashed a dinner party where Prince Regent was eating, said victory, and then the markets moved on the 21st. So, and then official news actually hit on the 22nd for the London Gazette. Now, there is and I got just a little bit more here, so hang in with me. But there's also a weird part. There's a guy named Mr. C of Dover. Some historians believe the actual first person to deliver the news of Waterloo to London wasn't Rothschild, but a mysterious guy known as Mr. C. He had been in Ghent, heard the news, made a mad dash across the channel, and he arrived sometime Tuesday night. And he may have beat the official courier by like 24 hours. But he didn't run to the stock exchange. He just started telling tons of people. I thought that was interesting. Obviously, the Rothschilds are very important throughout history as financiers, but Nathan Rothschild's been mythologized somewhat after the Battle of Waterloo. But there may have been some manipulation going on, at least a tiny bit.
It's kind of this combination of like an Enlightenment version of the Flash Boys, where he just had a more efficient information system, which gave him a structural advantage. But then it turns out that it wasn't even really a thing around the Battle of Waterloo. So it's also kind of like the tulip mania of the Netherlands. Like, did it actually even happen? It's more just like mythologized after the point.
Right.
It's like so many things where the propaganda of somebody that came decades after the event winds up more popular than the actual event itself.
And what ended up probably happening is a lot of people were just guessing. I mean, there was wild speculation, and people were just throwing out random guesses. You know, we can speculate all we want, but anything could have happened. The courier could have died on his way there, and then something else turned the war. I don't know, right? It was still speculation.
It's interesting your point about Mr. C, too, because, I mean, that guy made it to London arguably first, but I doubt enough people believed him. He probably wasn't credible enough to really move any real volumes of people's financial bets. So he had the truth, but he was essentially just one voice among thousands of rumors.
Yeah, another thing to note here is that Rothschild probably wouldn't have cared because he made way more money funding the war than he would have on betting on those bonds.
I love that the speculation. God, that's just like people that rail against the Fed today. You know, they're kind of missing the forest for the trees, so they make up this wild story that's a little bit more marketable. Interesting.
Yeah, so I thought that was a neat legend. Yeah. Well,
Yeah.
On that note, this has been the Capital Call. I'm Quinn Millegan.
And I'm Drew Millegan.
Oh, and I'm David. Thanks for having me on, guys.
And as always, stay liquid.
Yeah, we'll see you every Monday morning. Take it easy, guys.